And all right, so once again, this workshop is brought to you by the UO Financial Wellness Center. And that brings us to this workshop, which is Investing 101, an introduction to the basics of investing. And as for a little introduction to myself, my name is Lucas Murphy. I am a peer financial coach with the Financial Wellness Center. And just a little background, I did my undergrad here at the UO. I majored in accounting, and I'm currently in my final term of the Masters of Accounting program here at the UO. And so should you have any questions after the workshop, please don't hesitate. Feel free to shoot me an email. It's listed right here, lmurphy@uoregon. And so before we get into the bulk of our workshop, I have a few slides on the Financial Wellness Center and the services we provide to our students. So here at the Financial Wellness Center, our mission is to financially empower students with the knowledge needed to make sound financial decisions during and after college. And so our focus areas, or the big five as we call them, are earning, spending, borrowing, protecting, and saving and investing. And being that this is a basics of investing workshop, we're going to be focusing on the saving and investing pillar. But there are other resources available covering the other four pillars on our website, which is financialwellness.uoregon.edu. And so for as far as how we reach our students, the Financial Wellness Center provides financial education workshops like this one to US students. And the really nice thing is that if you're unable to make the live session, all of our workshops are recorded and added to our website for on-demand access. And once again, you can check those out at financialwellness.uoregon.edu to see both past workshops as well as the schedule of the upcoming workshops. We also offer one-on-one peer financial coaching appointments to give students the opportunity to ask for any advice, or not really advice, information or clarity on whatever specific financial topics they might be curious about. And those are conducted over Zoom given the current circumstances, but hopefully those will be up and running again in person come the fall. And finally, the Financial Wellness Center is striving to build partnerships across campus, whether that be with student athletes or graduate programs or an on-campus club. Our goal is to offer financial wellness enrichment opportunities to all students and just make our services as accessible as we can. And all right, so for the agenda for this afternoon or evening, whatever, so we'll start with a basic definition of investing, along with some explanation as to why one should consider investing. We'll then touch on some of the most common types of investments and their associated risks and returns, followed by a few helpful resources that new investors might use to their advantage. And we'll then discuss the process of picking a broker. All right, and so for the learning outcomes of this workshop, hopefully you will be able to walk away and gain an understanding on what exactly investing is, the long-term nature of investing for your future, the different types of investments that are available, and how to pick a broker and understanding the different fees that are associated with them, if any fees. So the first question, what is the S&P 500 index? Or sorry, what is the S&P 500? That is an index, which is just a way to measure something. And the S&P 500 index tracks the stock of the largest 500 US companies. And the S&P 500 is often used as a synonymous phrase for the market. So you might hear someone say, oh, the market was up today, the market was down today. And oftentimes they're referring to how well the S&P 500 is performing. And so number two, novice or new investors should focus on timing the market to maximize their investments. And this is false. New investors should not worry about timing the market. They should focus on doing research and thinking long-term for their investments. There's a great investment strategy called dollar cost averaging, which we're going to touch on more in a bit, that provides an alternative to timing the market. And timing the market is more associated with day trading than investing, which is very different than investing. And so number three, if you buy a company's stock, you own part of that company. Way back in the day, you used to get a physical slip of paper that represented a stock or ownership share of that company. but obviously today it's all digital now, just like everything else is. And another point, that stock or ownership share is also often called equity. You might have heard that before. If someone has equity in that company, that means they have an ownership share in that company. And all right, so number 4, which organization insures you against your losses in the stock market? And although it would be really nice if someone did insure your losses, there is no organization that insures losses against the stock market. That is the nature of the risk reward trade-off, which we're going to get more into in a bit as well. And lastly, number 5, in general, investments that are riskier tend to provide higher returns over time than investments with less risk. That is true. In general, greater risk does lead to greater rewards over time. The key word here being over time. And so before we get into a bit more detail, I wanted to quickly go over and define some key terms that will be used throughout the workshop. I know a lot of you are probably familiar with these terms, but I just wanted to make sure that we're all on the same page so there's no confusion. So first is risk, which risk is the chance that the outcome of an investment will be different than the expected outcome. Or another way to think of it is any uncertainty with respect to an investment. And with investing, the higher the risk, it's usually associated with a higher reward. So to maybe put this in a more colorful example, I'll use gambling at a casino as an analogy. So you make your bet at whatever game you're playing, and the risk in that instance is that you don't know whether you will win or you will lose your bet. So that's the risk you're taking on. And with this, if you bet a small amount of money, you might lose your bet or you might win a small amount of money in return. But if you were to bet a larger amount of money or take on more risk, you can win a lot more money as a trade-off and compensating for this increased risk that you're taking on. And so now this is gambling, obviously, but the same concept of risk and reward applies to investing. All right, and next is return, which goes hand in hand with risk. The return is simply the money made or lost on an investment over time. So you might have heard of the big returns, say with like maybe Bitcoin or Tesla that have been happening recently, which means that these big returns is people who have invested in those assets early on are making some money off of that or a positive return. So the return is just the money made or lost on an investment. And next up is inflation. Inflation is the decline of purchasing power of a currency over time. For our case, we use the dollar. And so maybe you've heard your grandparents or some other older folk talk about how back in my day, you could buy a hamburger and French fries and a drink for 25 cents, where today, just a cheeseburger at McDonald's is like $1.50 or $2 or something. And so that is inflation right there. Basically, inflation means a dollar in the future is less powerful than a dollar today. All right, and next we have volatility, which is a measure for the distribution of returns for a given security and how much and how often its price changes. So a higher volatility means higher risk. And so to go back to my mention of Bitcoin earlier, I had mentioned the big returns it has seen, but with those returns is much, much more risk and volatility associated with it. I think Bitcoin is actually the most volatile asset ever, meaning that its price goes up and down very frequently and extremely unpredictably. So it's a very risky asset. And lastly is a broker, which is an individual or a firm who acts as an intermediary between an investor, aka all of us, and a securities exchange or the stock market or a bond market. And this is because these exchanges only accept offers from individuals or firms who are members of that exchange, which the brokers are members. So we use brokers as a sort of middleman to access these exchanges. And we'll touch more on brokers here in a bit. All right, then let's get into the investing. So what exactly is investing? A basic definition is the act of allocating resources, usually money, with the expectation of generating income or profit. The key word here being expectation, because investing involves taking on risks and investing is different from saving. So the picture here on the right is a hypothetical illustration of investing versus saving. As you can see with saving here, this line on the bottom, this flat line, there's little to no risk, but the returns are also minimal. So here on the x-axis is time, and the y-axis is money or return. So with saving, it's completely flat or smooth line, no risk associated, but a minimal return, as opposed to the investing line, where these up and downward movements indicate the risks or the volatility associated with that investment. But you can see that the return is much greater than saving. But however, these returns are not guaranteed. There's much more risk associated with investing than saving. And investors use the word volatility to describe the frequency and extent to which the price of an investment moves up or down, which I mentioned earlier. So here's a little illustration of volatility. The straight blue line indicates very low or no volatility. That's like the savings line we just saw. Whereas the green line indicates that there is some volatility with these up and down movements in the price. And another aspect of the riskiness of investing is that it's very difficult to predict what's going to happen in the future. It's hard to predict what companies will do better than others in the future, or whether there's going to be a stock market crash or a boom, or if, say, a government or a corporation will be unable to repay their debts in the case that we're talking about bonds. And in comparison to saving, investing has both gains and losses, whereas savings is just a very small gain over time, not really any losses associated with saving. But with investing, the goal is to be well enough diversified so that over time, your gains will outweigh your losses. Okay, and so one way to mitigate that inherent volatility with the prices of assets that comes with investing is called dollar cost averaging. And dollar cost averaging is an investment strategy where an investor decides to divide up the total amount of money to be invested across periodic purchases of a target asset. And they do that in order to reduce the impact of the volatility on the overall purchase. So these periodic purchases occur regardless of the asset's price and at regular time intervals. Say, for example, if you had $100 that you wanted to invest in some stock, rather than investing all of the $100 at once, excuse me, you might want to invest $20 a week for 5 weeks or $10 a week for 10 weeks. And by doing that, you are reducing the overall impact of volatility that it will have on your investment, because the price of whatever you're investing in will likely vary each time you make that investment, being that you're making periodic investments. So the investment will not be as highly subject to the volatility as a result. And using dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed with regard to the asset price. So instead of dumping your entire $100 into the stock when it might be at a high point and then watching it fall over the next few days and losing money as an effect, you can average out the cost of the investment over the different time periods to reduce your exposure to volatility. And so, yeah, that's just a very simple yet effective strategy to mitigate the volatility associated with investing. All right, so now that we've touched on what exactly investing is, the risks that are associated with it, and how to mitigate some of that risk with dollar cost averaging, we're now going to get into the reasons as why one should consider investing. And so with investing, the first reason is that you might outpace inflation, which we learned earlier is the fall in the purchasing power of money. And if the rate of return on an investment is greater than the inflation rate, then you are outpacing inflation, they call it, which means that your investment is growing at a faster rate than the rate at which the value of the dollar is decreasing. And if you hold on to your investment long enough, you can reap the benefits of compounding interest. For example, let's say that you invest $100 into some asset that has an average return of 10%. After 1 year, the value that you own of that asset will be $110, that original 100 plus the $10 or the 10% return. But after 2 years, its value will be $121, that new starting value of 110 times multiplied by the 10% increase, which is now $11 instead of $10. And although that might not seem like a big difference at all in this short-term simple example, the exponential growth from compounding interest can result in very large returns if given several years of compounding along with consistent investment. And additionally, saving alone might not be enough for your future goals. The bigger your return on investment, the less you have to set aside for the future. So these are just some of the many reasons as why one might consider investing as opposed to just saving. And so for a bit more on why one should invest, here is a chart showing the historical average returns for different types of investment. As you can see here on the left-hand side, stocks provide the highest average historical return at about 10%. And this is measured by the S&P 500 index, which we learned earlier is a metric that tracks the performance of the largest 500 US corporations. And followed by stocks is bonds, which have about a 6% average return. And this is measured by the Barclays US Aggregate Bond Index, which Barclays is just a big bank that they made this metric that tracks bond performance on average. All right, and finally here, this third pillar is the traditional cash investment, and these earn the lowest returns. This chart says about 3%, but that is using the 30-day treasury bill, which is not the best proxy in my opinion. So just to provide a bit more of an applicable approximate, a traditional savings account that all of us are probably familiar with, those often earn less than 1% interest annually. And while right now the inflation rate is a bit lower than this 2.7 here, right now it's around 2.2. I'm gonna have to look that up, sorry, but it's a bit lower than this. But that inflation is still higher than the average return associated with a savings account or a cash investment. And so here's a better illustration of that idea of compounding interest I mentioned earlier. Again, this graph is hypothetical, but it does do a good job of illustrating the historical average returns for the different types of investment as well as compounding interest. So here we have a few different scenarios. This person is investing $250 per month over the next 40 years. So if you were to follow that investment scheme, $250 per month for the next 40 years in a basic cash investment similar to a savings account, that investment would be around $230,000 in 40 years. And this might be even a little generous with that higher estimate of 3%. But if you were to do that same investment scheme in investing in a bond market, that investment would be worth around $550,000 in 40 years, given that average return of 6% per year. And finally, here on the left, you see that if you were to invest in a well-diversified stock portfolio, averaging around a 10% annual return, which is that of the S&P 500, that same investment could be worth around $1.6 million after 40 years, which is quite a contrasting difference when you look at investing in stocks compared to a traditional savings account. And although this is a hypothetical scenario, it does do a good job depicting the power of compounding interest along with the various returns associated with each different investment vehicle. And I think the biggest takeaway from this chart is that building wealth is 100% achievable through smart investing. If you're careful and consistent, you can generate sound returns. While you might not be able to afford to invest $250 per month right away, you can start with something smaller, like 50, even 20 bucks a month, and just work your way up from there. All right, so now we're gonna go into a little bit more depth into each type of investment. Although it might seem a little overwhelming at first, I'm sure that with a little time and effort, you all can have a pretty solid understanding of these in no time. And, Sorry. And so here is what is called an investment spectrum. As you can see on the left-hand side are the cash investments, which are associated with lower risks, lower returns, and shorter time frames. These would be called the safest investments. While on the opposite side of the spectrum are equity investments, or most commonly stocks, which are associated with higher returns, potentially higher rewards, and a longer time frame. And these would be called riskier investments in respect to the others. And as for bond investments, they fall in the middle of the spectrum, offering lower risks than equity investments, yet higher returns than traditional cash investments. And bonds are classified as a fairly safe investment. And now I'm going to touch on a few examples of each type of investment. So first we have traditional cash investments. So for traditional cash investments, or the safest investments, these include your standard savings account, money market accounts, and certificates of deposit, or CDs. And so a standard savings account is the savings account that most of us are probably familiar with, to encourage individuals to keeping their money with them. A bank will offer a very low interest rate. On average, it's around 0.05%, so less than 0.5% on the money kept in a savings account. And then we have a money market account, which is basically a hybrid of a checkings and savings account. They usually offer slightly higher interest rates. Those are usually around 0.08 to 0.11, or around 10% returns, which is higher than the 0.05% of a savings account. And finally is a certificate of deposit, which is essentially a savings account that holds a fixed amount of money for a fixed period of time. And in exchange, the issuing bank pays interest, usually around 0.5% to 1%. And the longer the time period that's agreed upon by the terms of the certificate, usually there will be a higher interest rate associated with it. And although these investments are in fact very safe, their associated returns are on average less than the rate of inflation. So although technically your amount of money is growing, its value in terms of buying power might not necessarily be growing given the higher inflation rate. All right, so now for bonds or debt investments. Bonds are issued from companies, governments, or other organizations to raise money. A bond is essentially an IOU in the sense that your investment is a loan to an entity who will repay your initial investment, or the principal it's called. And at the end of the specified time period, that's when you will get your principal back. But during the life of the bond, you will receive regularly occurring interest payments. And those are all specified within the terms of each specific bond. And bonds can add a sense of stability to a diversified portfolio, being that they are a bit safer than, say, an equity investment, as we saw in the spectrum earlier. And so you can purchase bonds from the federal government, from corporations, or even your local city. Those are called municipal bonds. And on average, the return of the bond market is around 6.3%, according to that Barclays index we saw earlier. And now for equity investments, or most commonly known as stocks. A stock is a security that represents a share or partial ownership of a company. So the more stock you own, the greater your share of ownership is of that company. So stocks go up in value as the company performs well, and they go down in value when the company performs poorly. And the value of a stock investment is much more volatile than bonds or cash investments, because it's very dependent on how well the company performs, which is really hard to predict. And so different stocks result in different returns that vary based on a number of factors, including the size of the company, the industry in which they operate in, and the stage of maturity of the company. Say, for example, younger new companies have much more room for growth, like maybe Tesla we've seen recently, whereas an older mature company like Coca-Cola, for example, isn't experiencing quite as big as returns as these young growth stocks are, but it's a very steady return, and it's one might say a less risky stock than these young growth stocks. And so the next investment we'll talk about is called a mutual fund. A mutual fund is a type of financial vehicle that is made up of a pool of money collected from many investors to invest in securities like stocks, bonds, and other assets. And so mutual funds are managed by a professional money manager who they charge a fee for the services they provide. By the services include picking which securities to invest in so that the individual investor doesn't have to worry about that. They just pay this professional money manager to do it on their behalf. And in return, these fund managers usually charge a base or annual fee, which is a flat fee charged every year, as well as an additional fee in the form of a percentage of the gains that the fund creates. So this money manager will take the funds given to them, they'll collect their yearly fee, and if they generate a profit with the funds given to them, then they keep a small percentage of that profit as part of their fees. And so mutual fund managers attempt to outperform the market by conducting extensive research and hand-picking which securities they will invest in. And so each individual investor's share of the gains of the mutual funds are proportional to the size of their investment they made into the fund. And lastly, I'll briefly touch on exchange-traded funds. So an ETF, or an exchange-traded fund, is a security that involves a collection of securities like stocks that often tracks an underlying index. And ETFs are similar in nature to mutual funds in the sense that they're an investment in a basket full of different securities rather than just one specific security. But the biggest difference here with an ETF is that they are listed on exchanges, hence the name exchange traded fund. And they're traded throughout the day just like an ordinary stock is, whereas a mutual fund, you can only buy into it at its set price at the market close or at the end of a trading day. And additionally, ETFs often have lower fees associated with them than mutual funds, making them potentially more appealing to a novice investor who's trying to avoid paying those fees, but still reap the benefits of a diversified basket of goods. And some examples of ETFs are the S&P 500 Index ETF, which tracks the S&P 500 index, which we learned is the measure of the top. It tracks the performance of the top 500 companies, and each company's share of like how much of that index is allocated to it is based on how large the company's is. So the largest companies will have more of the money in the ETF invested to them compared to like the 500th largest company. And so if you want to check out the S&P 500 Index ETF, its ticker is SPY, SPY, and you should be able to find that on any brokerage account. And so rather than handpicking which stocks you think are going to do well like a mutual fund manager does, ETFs allow you to easily diversify and invest in an industry or the market as a whole in the case of the S&P 500. And some other ETFs can include oil companies or utility companies or companies that are focused on sustainability. If there is a classification for a group of companies, there is probably a good chance that there is an ETF out there somewhere that tracks them. And most brokers provide a detailed list of what ETFs they have available. All right, so now we're going to touch on the idea of diversification. This picture provides an example of what a diversified portfolio might look like. Notice how there are different size shapes of the pie that represent the different types of investment. And the idea with diversification is to avoid putting all of your eggs in one basket or all of your money in one type of investment. Say, for example, you put all of your investing money into the stock of some company. If the company does well, you might see a healthy return. But if that company does poorly, you might lose your money and suffer a sizable loss. So by diversifying, you are spreading out the risk that you're taking on. And the goal is to be diversified enough so that the losses that may result from some of your investments are largely offset by the gains that result from your other investments. All right, so now that we've gone over the basics of a few of the most common types of investments, here are a few resources that you might want to use going forward to expand your breadth of knowledge. Yahoo Finance is a great kind of one-stop shop. They provide up-to-date financial news, data, and commentary, including stock quotes and company news. Investopedia is a great resource for a quick search on an investment term that you might not be super familiar with. They provide financial and investment dictionaries and detailed explanations on just about anything. I really like Investopedia. If I come across something that I'm not 100% confident on, I can just quickly search it up and they'll provide me with a very extensive, clear definition that I can walk away with. And as you move forward with investing, you might want to consider using SEC's Edgar website. They provide access to all the public companies' financial records. These include the yearly financial statements that companies are required to publish, and management discussion and analysis reports, which give a lot of detail on the direction a company is moving in and the risk that they expect to face in the future. But fair warning, these financial reports are very long and very dry. So take that how you will. And so now picking a broker. So when you are picking a broker, there are quite a few things to consider. First being, is there a minimum deposit required, meaning that you have to invest a certain amount of dollars right off the start? Are there annual or monthly maintenance fees for that account? Does the broker offer access to a trading platform as part of their free membership? I know with some of these brokers, it's like sign up for free, but then you have to pay a premium to actually use the services. So make sure you pay attention to that. And if you are interested in mutual funds or ETFs, does the broker provide fee-free options? And the point in case being here is that there are a lot of options for brokers out there, and it's important to do a lot of research before deciding on one. And just to provide a few examples of some of the more common brokers out there, Robinhood is very popular right now for a lot of good reasons. There are no fees involved with Robinhood, but as a trade-off, there is no access to mutual funds. And there's also little to no professional guidance that come with Robinhood. So if that's something you're looking for, you might want to consider a different broker. As for TD Ameritrade, Fidelity, and Charles Schwab, these are all pretty comparable in the sense that there are no fees for trading stocks or ETFs. And in addition, they offer access to mutual funds with a management fee. And they also have much more educational offerings than Robinhood does. And with all of these brokers listed, there are no minimum account fees, which is really great for a new investor trying to get started. And I believe that all of them except TD Ameritrade will give you a free stock when you sign up, which is just a really fun bonus. And so the point here is that all of these brokers are great starting points for the novice investor. And you can't really go wrong with either of them. It's really just what you're looking for as an individual. So just make sure to ask around and do some research before making a decision. And just to provide a simple real life scenario to make all of this a bit more applicable to students. Say, for example, you are gifted $1,000 for graduation and you're not sure what to spend it on. And this number, $1,000, is completely arbitrary. It could be any amount. And rather than making an impulsive purchase, you can start investing for your future instead. So you can put some or all of the money into one of the different types of investment we just covered and make your money work for you. Rather than buying some material item that will depreciate in value over time, you might buy some stock in a couple of different companies and watch your money grow over time. And so as we wrap things up, I just want to summarize a few key takeaways that I hope you guys can leave with. So remember that investing is a marathon, not a sprint. Think long-term and understand that the returns we desire take time. There are no shortcuts. Additionally, always remember to do extensive research before making any financial decision, whether that may be deciding on a broker or deciding on an investment. Don't just follow trends. An informed decision is always better than an impulsive one. And becoming familiar with the different types of investment vehicles and different industries within the market will be very beneficial for you as you progress as an investor. So just kind of try and develop a desire for knowledge, and always just try and continue to expand your knowledge. The next is don't swing for the fences, or don't put all of your money into one single investment, hoping that it's going to boom and you get rich quick. It's not a get rich quick scheme, it's investing. And so remember to diversify to avoid that. And lastly, you can start investing in your future and generating returns even if you have limited access to capital to start off. Like I said, it's a marathon, not a sprint. And even if it's something small to start off, like $20 a week, maybe $10 a week, that's a great starting point, and it puts you ahead of a lot of people who are doing nothing. And so here I have just a simple 5-step plan that hopefully you can take away and to get started investing. So first would be to determine why you want to start investing. Do extensive research before you decide on a broker. You can ask people who you know what broker they use. There's also a lot of great resources on the internet as well. Second would be determine your risk tolerance and comfortability. If you're more of a risk averse person, consider cash investments, bonds, or ETFs. If you're more comfortable taking on some additional risk, perhaps you want to do some extra research on a few specific companies and decide if you would like to invest in them or not. And third, regardless of your risk tolerance, it's always do your research before making an investment. Like I said, an informed investment decision is always better than an impulsive one. And fourth, diversify both your knowledge and your portfolio. Learning more about the different types of investments that are out there will better your ability to diversify your portfolio and mitigate risk. And in terms of diversifying your knowledge, try not to get all of your knowledge from one source. Try using different sources, whether it's books or different sources on the internet or different friends. Just try and get different perspectives and opinions on things rather than just being set in stone one way. And finally, be patient. Investing is not a get rich quick scheme, and patience is imperative. All right, and as we conclude, just remember to visit our website at financialwellness.uoregon.edu to schedule a one-on-one appointment with the peer financial coach if that's something you're interested in. We have appointments available through week 10 of this term. And just a reminder to stay connected with the Financial Wellness Center. You can find us on Instagram and Twitter at UOFinWellness, as well as YouTube and Facebook at UO Finance.